Hi everyone. We have already dealt with, for example, the types of activities where we said that is operating, investing, and financing, right? What you want to do is now talk about the method of reporting in terms of how do we prepare the statement of cash flows, right? You would recollect that initially we talked about the perspective of there are two ways to prepare this statement of cash flows. One is the direct method, and second is the indirect method, right? We'll be of course discussing what is the meaning of these two, in terms of the relevance of that or significance of that. But what you also want to remember here is that both these methods would only be applicable to the operating activities, right? So whether you prepare a statement of cash flows under a direct method or an indirect method, the preparation of the investment activities and financing activities remains the same or remains unchanged, right? Essentially, it is the operating activities which have to be differentiated. Okay, and that's why you need to be remembering that if your examination talks about a direct method or an indirect method for, let's say, operating cash flows, it would exactly mean to do the same thing, right? Instead of a full statement of cash flows, you are probably preparing a portion of that for the operating cash flow specifically. Okay, let's have a look at it. It says that when you look at the operating activities, of course, there could be a method in which you look at, using a direct method purely about your cash receipts and payments, right? I mean, it's as good as, analyzing your cash book or a cash ledger in terms of what are your sources of money, where the money is coming from, what are the receipts, and what are the payments, for example, right? That's the way you start looking at it. However, under the indirect method, you are expected to build the change or the movement by using the statement of profit or loss as the basis, right? So that amount is adjusted for the effects of multiple transactions. I mean, imagine it like this: if you have, let's say, a profit of, I'm just using a number, let's say 100 crores in a business. Okay, but then you also know that this company has charged depreciation of 20 crores. Essentially, you're talking about a profit excluding the impact of depreciation, which is 120 crores. This depreciation that reduces your profit does not impact the cash. So in a way, when you look at this 100, it does not represent the cash amount of the business, right? So you have to obviously make an adjustment for something like depreciation in this case. Similarly, there could be also other aspects that you need to adjust, right, with respect to some accruals or deferrals, with respect to the cash payments or the cash receipts, etc., to arrive at the cash from operations or cash from operating activities. That's the reason why this method is called as an indirect method. Okay, your examination importantly can use either of the two, or maybe it wants you to look at both, although it is unlikely to really go for both the activities. But importantly, you should be aware of it. What exactly is the information provided, and can we use that information to, let's say, arrive at the cash flows from the operating activities? Okay, think over it like this. Let's take a small example to understand why would or how would that vary. I'm saying that, let's say there is a revenue of 1,000 in a company's statement of profit or loss. Let's say there are also cost of goods sold, which are 800, which gives me a profit of 200. Let's call it a gross profit of 200. Okay, now I'm saying that there are expenses, so operational expenses of 60. There's a depreciation, let's say, of 20. There is an interest cost of, let's say, 15, and I get my profit before tax, which is 200 minus this would be 95, so that is 105. Let's say tax is 25, which gives me my profit after tax of 80. Okay. Now, what are we doing here is under the preparation or the preparation for the preparation of, let's say, cash flows from operating activities, we would want to make use of the profit, and we probably want to take a start, let's say, from this figure. We can also do it here, but don't worry about it too far. Okay, so we would say, let's use the PBT as the basis, and we say we start with 105. Okay, now I know that there's an interest cost which has reduced my profit, but it is not operations. It's a part of my financing activity. So I have to add back something which is not operations, which is the interest cost. So I will add this 15 back. Likewise, my non-cash item of depreciation, let's say 20, and assuming that this is all cash, this is all cash, this is all cash, I can arrive at my profit, which is 0, 147. Right? This is my cash from operating activities. But I also paid taxes. So when we started with 105, we had already factored in 25. So I would need to, of course, remove this 25 to arrive at my profit of 115. This is something which is referred to as indirect method. All right. Now, if I were to do it in a different manner, let's say, as we said, that these are all cash items, okay, including this tax, for example, I may say my receipts from the customers, which is 1,000, minus payments to suppliers, which is 800. Okay, then are my operating expenses, which is 60, and then my tax payment, which is 25. Okay, all I've done is I picked those items which I'm paying in cash and which pertain to, which relate to operations. Okay, so the first step that you always want to remember is which are the items which relate to operations, and the second part is whether these are in cash or not. Right, so when I look at this calculation, that gives me 200, 140, and this minus 25, that gives me again 115. And this is the way I'm using, let's say, a direct method to arrive at my cash from operations or cash from the operating activities. Let's have a look at this example. It says that following information pertains to operating statements of Platinum Limited for the year ended 31st of March 20. You're required to find out the cash from operations. As we said that it's not the entire statement of cash flows, but the cash from operations, which is basically about your cash flows from operating activities, right? By direct method and indirect method given the following information. Okay. Now we are provided a complete profit and loss account, statement of profit or loss, and we are also provided the balance sheet, right, for the two comparable years, right? And then it says that this is the continuation of that. Now, importantly, when I look at this entire information available to me, okay, I know that there are sales, there are cost of goods sold, overheads, depreciation, interest, loss on sale, and then taxes. Let's identify which of these items would be a part of, for example, your operating activities or not. Okay, this is operations, this is my first classification, this is operating, this is operating, this is non-cash, right? This is financing, this is non-cash, okay, and this is again operations, right? So I can pick these items to arrive at my answer, but importantly, I don't know whether these are cash or not. Okay, whether this entire 10 lakh rupees sales is made in cash, or is there some credit sales also. Okay, now how do we arrive at that? Okay, so we say, instead of assuming that this is all in cash, let's assume that this is all on credit. Okay, And then I use the information which is given in my balance sheet, for example, of my trade receivables. Okay. So let's try to do that. I'm given that my opening balance is 14,000. My closing balance is 20,000. And if I say that my sales were, let's use that information, 10 lakhs, the balancing figure can suggest to me, can give me my collections. That is my receipts from the customers. Okay. The same way I can do the exercise for my payables, right? Let's look at the next page here. I think that we can use. We are provided with the amount of the payables. So we say opening balance, which is 16,000, closing balance, which is 24,000, and I'm provided. Now this is given to me as a cost of goods sold. So I don't know at this point in time what are my purchases. So we need to even do that. So let's do one thing. Let's take the inventories now. Okay, so my inventories opening balance, which is 26,000, and the closing balance is 24. Let's bring it here. 26,000, closing balance is 24,000, which means that my cost of goods sold is 7 lakh, which actually suggests my purchases must have been a difference of 6,98,000. Okay, and I can use this as my purchase in my payables balance also. So this is my purchases, 698,000. That was basically my balances were 16 and 24. So that's a gap of 8,000. So that would be 8,000 less, which is 6 lakhs 90,000. This becomes the payment, right? This is my payment to my suppliers, right? So this is the way we can arrive at, for example, what are the cash paid, etc., for any of these items. Okay. Now we are specifically focusing on cash from operations, right? So even the payable for expenses could be important. The balances of 14 and 20. I'm just using this space, although we have, of course, space available in the next slides also. So let's say expenses outstanding, opening balance, which is 14,000, closing balance, which is 20,000. My expenses during the year, that is also provided to me in my statement of profit or loss, which is 1,10,000. Okay. So that becomes 104,000 is the payment that I have made. Okay. So effectively, we've got these numbers in terms of what is my receipts from the customers, right? What is my payment to the suppliers? What are the expenses payment? There's also a tax payment that I would want to remember amongst the all operational items. So we've got this figure, this figure, this figure, and this figure, right? You can use these numbers straight away to arrive at what, for example, is the cash from operating activities. Let's have a look at it. It says that my collections are 994. Okay, my payments are 690. My further payment of expenses is 104, and my tax payment is 60,000, right? So this is 994. So let's use that reference, right? So cash from operating activities using direct method. right? Cash from operating activities using direct method. Receipt from customers, which is 9,94,000 less payment to suppliers. That was 690. Okay, this figure 6,90,000. Okay, less expenses paid, which is 104, and less, of course, tax paid, which is 60,000. Okay, if I do this calculation, I've got ₹1,40,000 is my cash flows from operating activities, right? So this is the amount of 1,40,000. We can also, and we are required to, by the way, in this question, also do the same calculation under the indirect method. Okay, let's do this together. Let's do one thing. Let's go back to the statement of profit or loss account, wherein we are given, for example, that our profit is given at 1,66,000. Okay, so let's start from there. We're saying cash from operating activities using indirect method, right? You're given profit before tax that amounts to 1,66,000, right? That's the number that we want to remember, right? And then we have this item, which is non-cash, this is financing, and this is depreciation. We just need to add these all back, right? Loss on sale, interest paid, and depreciation. So we start with 166. Right, we're saying add depreciation, interest expense, and loss on sale of asset, right? These numbers are from total depreciation, which is 14,000, interest is 6,000, loss on sale is 4,000. So 14, 6, and 4. We want to pick these numbers: 14,000, 6,000, and 4,000, right? Now, we also want to look at what are my changes in working capital, right? Essentially, on my receivables, on my payables, on my inventories, for example, right? What are the changes? Because they are also arising because of the operations. So let's say receivables, inventories, and payables. When I look at these numbers, I use the balance sheet as a reference. There's also payable for expenses, by the way. So we want to pick them up as well, right? My inventories have declined by 2,000, right? So in a way, I'm releasing my inventory and I'm creating cash for myself, right? Notionally, but yes, the cash is created. So 2,000 positive comes. But as far as my receivables are concerned, there is an increase of 6,000. So in a way, my cash is getting invested, or cash is getting blocked in my receivables to the extent of 6,000. Okay. The same way, in my payables, there is an increase by 8,000. So in a way, my suppliers are funding that. Okay, so I'll be adding that 8,000 here. And similarly, we look at 6,000 as our addition for the outstanding balances, which is 14 minus 20 minus 40, right? So the numbers are, there's a decline, there's a positive cash from the inventories, 2,000. There's a negative cash of 6,000. So let's use those. From receivables, I'm looking at 6,000 negative. So this is also outstanding expenses, by the way. Okay. My inventories were giving me a positive 2,000. My payables gave me 8,000 and my expenses gave me 6,000 positive, right? So this is 8,000 and this is 6,000. The net figure is, of course, changes is 10,000 net. And we just need to sum these numbers, which is 166 right, plus 14, that makes it 180. That is 190 and 200 less tax paid, which is 60,000, right? So we're given this 200 minus 60, of course, is also 1,40,000, right? So it does not matter, frankly. It does not matter at all whether we use a direct method or an indirect method. Of course, my cash from operating activities has to be the same, right? In that context, right? Let's have a look at the formal solution around this. It says that cash from operations or cash flow from operating activities by direct method, we had these numbers of 994 and then 690 and 104. And of course, the tax payments were resulting in my final cash from operations or cash from operating activities, right, as 1,40,000. On the other hand, when you look at these are all the sums that the workings that we have done, so they're all the same. If you look at the indirect method, right, this is where it is. You start with the profit after tax here. You can also start with profit before tax. That's the way we did. It does not make any difference at all, right? You just need to remember, if you start with PBT, ensure to reduce tax payment at the end. Okay, ensure to reduce the tax payment at the end, right? So we're adding those non-cash items or non-operational items, and any changes in my inventories would come and eventually result in the total amount of 1,40,000 there. All right. Okay, this is the question that we want to do from the the past exam. It says that this is something which came in the previous syllabus, but it doesn't change anything from an AS3 or Ind AS 7 perspective. So let's have a look at it. It says, importantly, use the direct method. It's a 5 marks question. Not much of an effort would be required. It says that from the following summary of the cash account for the year ended 31st of March 16 of X Limited, calculate the cash flows from operating activities using direct method. Remember, direct method actually means using your cash account, using your cash ledger in terms of what are your operating activities, pick them up and simply, bring that calculation, right? So all I need to do, importantly, all I need to do is pick up what are those items which relate to operations, right? My cash flows or cash sales would be essentially operations. My collections from receivables is operations. Trade commission is operations. My cash purchases is operations. Payables is operations. The rent paid, office expenses, income tax. These are all examples of operations, right? So essentially, I just need to add these amounts on one side and reduce these amounts on the other side to arrive at my cash from operations or cash flows from operating activities under the direct method, right? Everything else, let's have a look at it. Interest and dividend, because we have received, is investing. Loan from bank is financing. Sale of investment is also investing. Investment, it is obviously a payment, so it's again investment there. This is financing. This is also financing. They are irrelevant for me under this particular scenario. So all I'm saying is 1,50,000, 1,60,000 and 40. That makes it 350 here. Right. That's the amount. Against that, we have 130 and 144 makes 274. 274 and 50 makes it 350, 324, 324 and 55. That makes it 379, right? So we are saying that my inflows are 350 versus my outflows, which are 379, which means that my net cash flows from operating activity is a negative 29,000, right? That's the way we are looking at the calculation here, right? A very straightforward question, very, very straightforward question that you're able to kind of find an answer on this. Okay, right? Now, these are broadly around the next set of discussion where we look at how do we report some specific aspects? Okay, if I say, for example, I'm talking about, let's say, a purchase of a machine versus a sale of a machine, right? Let's say I'm talking about there's a machine which is purchased for 10 crores, but you also sold a machine of, let's say, 4 crore rupees. Should I report this at 6 crores net, or should I have two different sets of activities coming in? Okay. Very importantly, the standard always says report these separate to reflect the true information, true flow of money coming and going. You need to report these separately, right? An entity is required to report separately any major classes of gross cash receipts and payments from investing and financing activities. Okay, you would do it even for your financing activities. If you are issuing shares versus there is also a buyback, just in case in the same period, you report this and this separately. You can't do a netting off. Offsetting is not permitted unless there are specific aspects where you are required to report them on a net basis. We'll see what are those areas where these requirement of reporting on net basis is there, right? So from that perspective, you would actually be showing all those receipts and payments separately rather than netting off. Netting off would simply, undervalue how are the cash, how is the cash coming and going out. The people would not be able to make the right judgment about that, which actually means in my investing, let's say the example that we used, in my investing, there would be a purchase of a machine of minus 10 crores. There would also be a sale of plus 6 crores. So effectively you would report minus 4 outside, right? So it does not really change anything, but effectively these both are to be presented separately. Okay, just an example around the same. It says if during 2018-19 a building is purchased for 50 lakh rupees and another is sold of 70 lakh rupees, then you need to show them separately each of those items. Okay, the only exceptions, right, which are there, for example, in case of a banking company, in case there is an acceptance and repayment of demand deposits, right, or credit card payments, for example, you would start looking at it on that context, right? There could be funds held for the customer by an investment entity or rents collected as well as paid to the owners of property. It could be an agency which is operating, so you would always show them net, right? When do you do that? When the cash receipts and payments are on behalf of the customers, when that reflect the activities of the customer instead of the entity yourself. Okay, that's where, for example, you're required to show them net. Similarly, the cash receipts and payments for which the turnover is quick, the amounts are large, and the maturities are short, as we took the example of, let's say, credit card customers. It could be about sale or purchase of investments or other short-term borrowings with, let's say, a maturity of 3 months or less. This is very specific to specific industries or financial institutions. But then the fact remains, only in those cases the grossing up is not required, because otherwise that balloons your entire information on the statement of cash flows. That's the reason why it is prohibited. Okay. Similarly, you would look at it if there are the financial institutions, for that example of repayments or acceptance of deposits, or the placement of deposits or the withdrawal thereof, some other financial institutions may also be reported net. Okay. Similarly, that would apply to the cash advances or loans made to the customers and the recovery of that. That's how you start looking at the net presentation rather than the gross presentation. For any other entity at large, a gross presentation is mandatory. Okay. Foreign currency cash flows, as we said before, any foreign currency amount or any foreign currency amount lying in your bank, it has to be reported as a part of your cash and cash equivalents. But importantly, we also need to follow the perspective or follow the accounting of that any such amount, any cash flows has to be reported using, let's say, closing rate. If there are two different currencies, on the reporting date, that amount of currency, the other currency has to be converted in, let's say, INR as the closing rate. So there is no movement, but the value will change. Okay. So how do we report that part? Think about it like this. Let's say I have $100 of money with me, for example. Let's say, it's a money lying in a bank account, right? I know in the last year, in the previous year, I'm using an exchange rate of 70 rupees, which makes it 7,000 rupees. Okay. But now the same $100 is now worth 7,500. How do I report that? The easy part, report it at 7,500. Okay. But then, is there any incremental cash coming in? The answer is no. You're just revaluing that amount of cash with a gain of that 500. Okay. So in your books, there's no cash movement. There's a notional gain which has come. Okay. So how do we address that? We are simply saying that my profit of 500 must have been recognized, right? If I'm talking about the indirect method, where I say there's a profit of 500 because of this exchange, difference. There's a fluctuation or exchange currency fluctuations, of course, and exchange rate fluctuations for that matter. And there's a profit of 500. I would simply reduce that to arrive at my cash from operations, which is zero, because practically there's no cash. But if I look at my opening cash balance, I'm saying it is 7,000, and I'm saying now there is a change in the value to the extent of 500, resulting in my closing balance at 7,500. Okay, so that's how you start building the thought process of how to bring this perspective, and that is something which is explained. Unrealized gains or losses because of the exchange rate fluctuations are not cash flows, but the effects have to be shown in your cash and cash equivalents at the closing rate, and the movement has to be shown as well. Okay, this would apply, of course, to cash flows of foreign subsidiaries at this as on the date of the cash flows as they arise. Okay, if I say, for example, I think this is the example that we've used. Suppose the money is received on account of exports on 15th of January in US dollars, and you're preparing your financial statements in INR. Then naturally, you use the rate as on the date when you are doing the transaction, right? That's a transaction date or a closing date, as the case may be. That's where you start looking at the impacts thereof. Okay. Now, importantly, the next section is talking about interest and dividends. We say any cash flows from interest or dividend received or and paid should be disclosed separately. Importantly, you want to remember interest or dividend received is because of investment. Okay. Interest or dividend paid is purely financing unless it relates to a financial institution where it becomes operating. You just want to remember that any interest or dividend received for any entity that is not a financial institution or a banking company, it's because of the investment made. Similarly, any interest paid or a dividend paid is because you financed or funded your business. So that needs to be shown as a part of your financing activities, unless you're a banking company again. That's what you want to remember. And I think that's what it is basically explained as well, right? So any interest paid would be financing, any dividend paid would be financing, any interest or dividend received would be investing, right? However, importantly, any interest paid for a financing company would still be an operating activity. For a dividend paid is essentially a financing activity, because you're still talking about dividend paid on shares, right? And interest and dividend received would be part of your operations per se. On the taxes part, now this is a very straightforward example. You normally use taxation as a reference of operating activities unless they are identifiable to any financing or investing activities. Imagine any capital gain, very likely investing, right? Any dividend distribution tax, very likely financing. You need to assess that part and be able to take a decision about that, right? So let's say it talks about Smart Limited during the current year has paid an advance tax of 2,65,000. 15,000 pertains to tax on long-term capital gains, right? How do you deal with that? Effectively, 2,50,000 rupees is operations and 15,000 is investing activities. That's the way you want to, of course, explain that part. As mentioned, of course, cash flows arising from taxes should be classified as cash flows from operating activities unless they can be specifically identified with financing or investing activities. In the given case, the tax amount of 15,000 is related to investing activities. Therefore, the remaining amount, 2,50,000, should be shown under operating activities, and of course 15,000 has to be shown under investing activities. All right. Finally, we look at the remaining aspects, let's say investment in subsidiaries, etc. Essentially, when you look at any investments made, any cash paid, this is essentially a part of investments, right? And accordingly, where you use, let's say, the methods. Now, this is something we're going to discuss when you do the consolidation to the group accounting, right? Where we have references of equity method or cost method, for example. Then any movement of cash, etc., would be again a return on the investment, and accordingly that presentation has to be done, right? Now, I don't want to spend time here talking about what is the meaning of a joint venture or what is an equity method or an associate. When we deal with that at that point in time, we would be able to better appreciate that part. But essentially, when you look at any recoveries, etc., they would account for under the cash flows from operating activities per se. That's what you want to remember broadly if you look at this context here. Okay. Now, this would be a last but important case here. What if you are acquiring a business, right? And there's a change in the ownership interest. Importantly, what you want to remember, in case you are obtaining control or you are giving up control, okay, then essentially it's a part of investing activities. Okay. However, in case there is a change in ownership interest in a subsidiary, but there is no change in the control. Again, this is essentially a group accounting perspective, but you still want to just remember it here that if I'm, let's say there's a company A which acquires company B, let's say 80% shares in that, we can safely say that we just acquired control on the other business, right? What is the meaning of control, etc., is all covered in detail in the group accounting. But let's say if you acquired 80% control by paying cash, now this is investment. Okay, right? But would you say from an 80%, you are moving to, let's say, 85% or even 90% or even 100%? You don't acquire further control. You still control that entire business. So when you say there's a movement wherein there is no change in the control, for example, right? So there's no loss of control taking place, right? So what do you want to remember here, by the way? Sorry, just to kind of look at it again. If you're moving from an 80% to, let's say, 80 to 85%, or let's say even 100%, we still call it investments, right? However, when you are, let's say, at 80% and now you're reducing it to 75%, right? Essentially, you are talking about, an equity transaction, right? So there is a pure financing coming in place. You're just playing with the equity rather than talking about, let's say, what, an investment getting changed. So that's what you want to kind of remember as a perspective. When we deal with the group accounting, you are better placed to understand, these movements and the transactions around that. So all you need to remember is that in case there is a change in the ownership interest that do not result in loss of control would be essentially a part of your financing activities, unless it's an entity wherein you're looking at investments are made by the investment entity and the entire accounting is done through fair value through profit or loss. Okay, so as a refer to that, when you look at these equity transactions or investments in group accounting, then there are specific standards on consolidation. We would be discussing that at length, and then would be able to kind of bring that along. Okay, non-cash transactions we have discussed at length. We don't need to include them at all. They're all excluded in the entire perspective of the Ind AS 7, right? You just need to disclose them somewhere else and not use them for the purposes of calculation of statement of cash flows. There could be multiple examples. Let's say, acquisition of an asset or acquiring an asset, for example, or a business by way of equity shares, etc. or the debt being converted into equity and stuff like that. They're all examples of non-cash transactions. Okay. Now, if it says that, as an example, a fixed asset is acquired by Grow Limited for 5 lakh rupees from Scope by accepting the liabilities of 4 lakh rupees, and the balance is paid in cash, which is 1 lakh rupees. Now, the question is, how do you deal with these transactions? We are saying that when you look at such kind of transactions, right, effectively the net 1 lakh rupee is a part of your investments, right? And the rest all transactions are to be disclosed separately with respect to your, let's say, the acquisition of asset and the, let's say, the acceptance of the liabilities in this particular context. All right. The next section that we have discussed that already, but just a quick walkthrough on that. What is all included in the cash and cash equivalents? We said that we do not show the movements of, let's say, the cash and cash equivalents. It's not something that we want to reconcile. It's a part of the same, opening balance and the closing balance. So you need to obviously show that amount of what are those, components of cash and cash equivalents, and you do separately a reconciliation of those amounts with the amount presented in the balance sheet and the statement of cash flows. That's where you start looking at it and the movements thereof. Now, the only challenge that you would see sometimes is basically the value of that cash flow or the cash and cash equivalent is changing because of the unrealized gains or losses, right? We have already discussed that with a small example earlier. We have a quick example around this, which is reflected here. It says that Global Limited has a bank balance in a foreign currency amounting to GBP 1,000, which is 80,000 rupees at the start of the year. Okay. Presuming no other transaction takes place and the company's reported taxes, profit before taxes, 1,000 rupees because of the gain in the foreign currency balance at the end of the year. Now, how are we reporting? That is the question, right? It says that you're required to determine the closing cash and cash equivalents as per the balance sheet. Now, put simply, my opening balance is 80,000. There is a gain of 1,000. I would simply add that and make it 81,000, right? That is where you start looking at the reconciliation of the closing cash and cash equivalent. As far as my movement of profit is concerned, I would simply say my profit is 1,000, but this is an unrealized profit. So I would simply remove it, and there is no movement in cash at all. So that becomes nil. And that's what is explained. For the purposes of statement of cash flows, we are saying 1,000 is a profit, but it's an unrealized profit. So we don't have any profit or any change, the movement in the cash from that perspective, which means that my opening and closing cash balance are the same. However, importantly, for the purposes of reconciliation, I'm talking about my cash and cash equivalent is 81,000. Okay. Right. So that's something which we wanted to cover. What we have discussed broadly about the direct method and indirect method. This is relevant from the calculations and examination perspective. I should certainly be aware of the gross and net presentation. Also, I'm well aware of it. How do I deal with my non-cash items like loss on sale, gain on sale, depreciation, exchange fluctuations, etc. And finally, the movement of cash and cash equivalent is something I should be also well comfortable with. Okay. The last section of our discussion is the disclosures and, of course, the differences between Ind AS and AS3. The disclosures you need to disclose, we have covered this, the cash and cash equivalent balances, a reconciliation of those, right? What is the policy that you're using in terms of arriving at how do you determine your cash and cash equivalents, and also any amount of cash and cash equivalents which are not available to use by the group. There could be some restrictions on some cash, so need to be also reported separately. Over and above, you want to also, for example, give a disclosure with respect to the amount of undrawn borrowing facilities which may be available, right, in or for further future activities or future operating activities. Similarly, amounts of the cash flows with respect to interest in the joint ventures using proportionate consolidation, something to do with the group accounting. Don't have to bother too much about that here. Similarly, amount of cash flows representing increasing operating activities separately from the cash flows required to maintain the operating activities. And finally, your level of cash flows, the movement of cash flows with respect to operating, investing, and financing activities for each reportable segment, something which Ind AS 108 specifically deals with. All right. Now, this is the last section that we want to talk about is key differences between Ind AS and AS, Ind AS 7 and 3, AS 3. Not much difference you would find. Okay, specifically, you want to consider, by the way, bank overdrafts are a part of the cash and cash equivalents, but AS3 would normally treat as a financing part of it, right? The bank overdraft would be an example of financing rather than cash and cash equivalents. So there's a change in the presentation and classification both, right? Ind AS 7 also gives more detailed information with respect to, let's say, cash proceeds from mortgages or owners, or cash payments to owners to acquire or redeem the shares. Similarly, cash payments by the lessee for a finance lease, there was no such clarification available on AS3, which means that it could be inviting different interpretations around that. Okay. Similarly, there is a specific disclosure requirement for an entity to disclose the amount of cash and cash equivalents over which the control is obtained or lost, but AS3 did not include that requirement. I think one key difference you would always want to remember that this is something that we talked about in AS1 also, or in AS1 as well, which is presentation, that there's no such item or there's no such concept called as extraordinary items, right? So there's no such requirement to disclose, but under the AS, it was all required in each of these categories where applicable. Okay. And finally, when you look at the group accounting, right, you start looking at the references of equity method or cost method, what we briefly discussed a while ago. So something which you want to, of course, consider, but AS3 again did not cover these requirements at all. All right. What you just want to remember here is that essentially under the direct and indirect method, right, I need to be careful about it in terms of how do I calculate my cash from operating activities or cash flows from operating activities. For financing and investing, they don't really change at all. So you have pretty much the same model of presentation while preparing your statement of cash flows for investing or financing activities specifically, right? That's it from my side, by the way. Thank you very much. You all have a good day. Bye-bye.